is going to dip down. Now, here's how I order them. Hi, I want 100 shares of RUB at $20 or better. This is called a limit order. I've just put a limit of $20 on the amount that I would pay for each share of stock. Now remember, I said or better. Better for me means the price goes down. So if the going price falls today to $20 or less, I get the stock. If it stays above 20 bucks all day, I'll lose out on the trade. But at least I'm protected from spending more than I want to. Now, don't run out now and order a lot of stock. We're not quite ready. Before you buy, you've got to think about your personal financial life. How does investing in stock fit in? You need to know where you are now financially and where you want to be at some point in the future. And that brings me to the 3 principles of investment planning. Number 1, take inventory. Number 2, establish a reserve fund. And number 3, diversify. Let's take the personal financial inventory first. We have prepared for you a list of personal assets. Check out these items: cash, that's your salary, money in the bank, personal property, your investments. Total all these things up, and then look at the bottom line. That is how much you've got. Now you look at the other side of your financial life. This is what you owe, your personal liabilities: rent, credit cards, insurance, loans. You might add to this list any new debts that you'll be adding in the next year or so. And when you compare your assets and liabilities, you'll be able to see how much money you've got that isn't tied up, your liquid assets, which gives you some idea of how much you've got to invest. Now on to the second principle, establishing a reserve fund. A safety reserve is a pool of cash or cash assets that you do not invest in stock. The safety fund is there so that if you lose on your investment, if you put a lot of money on a stock and you lose it all, you won't lose everything, because you have another pile of money that you are keeping just in case. Very safe money, perhaps in a bank certificate of deposit or in U.S. Treasury bills, so when you need it, it's there. Now, how large this reserve fund is depends on your own particular circumstances. But a good rule of thumb is keep at least 20% of your capital, 20%, free at all times. Finally, diversify. This is really just common sense, but you'd be amazed at how many people there are who don't do it. Now, in the stock market, you're going to have lots of choices. Don't put all your money on just one stock. Now, follow this rule always. The larger your stock fund gets, the more important it is not to bet on one stock. So those are the 3 investment principles. Now, we've covered a lot of territory, and this is just the first segment, so I'm going to pause now, and I'll see you in segment number 2.
You are most likely to find newer, smaller companies listed on the New York Stock Exchange. True or false? False. You are most likely to find newer, smaller companies on the over-the-counter market. If you only want to spend a certain amount of money for a stock, what type of order should you place? A, a market order. B, a buy order. C, a limit order. The correct answer is C, a limit order. What are the 3 principles of investment planning? The 3 principles of investment planning are: 1, take inventory. 2, keep a reserve fund. 3, diversify.
Come here for a second, a little closer. There's something I want to tell you now. Somebody is bound to come up to you sooner or later and say something like, you gotta buy stretch rubber band stock, very hot stock. Don't do it. Tips and rumors lose you money. If you come into the market buying up stocks randomly in companies you know nothing about, you might as well go to Las Vegas. If you want to be a successful investor, don't guess. Investigate. Take a good hard look, ask a lot of questions before you buy any stock. And the most important question in any transaction is why? Why buy this stock rather than any other? Why buy Stretch Rubber Band and not Goodyear or Firestone? To answer those types of questions, you've got to devise an investment strategy for yourself. And basically, there are two methods for making money in the market: investing and trading. Investing is buying stock for the long haul. You buy shares in a company and you hold on to them, giving the company and the stock time to grow. Trading, that is buying and selling stocks quickly. You get in, you get out rapidly. You look for the short, quick price jump, you make your profit. Trading takes a lot of skill, it takes a lot of nerve. Most people are going to do better investing for the long term. Now, once you have a strategy, you're ready to start examining a particular stock, and you have to ask, is it a good buy? Will it grow? Is it safe? Your first step should be to investigate the industry. Look at the business you're getting into. Is it a growing or declining industry? If the industry makes a product that fewer and fewer and fewer people want anymore, then it probably will not be a good investment. Is it a boom or bust industry? Most industries are affected by the ups and the downs of the economy. Luxury items may do poorly in bad times, while necessities, they just keep on selling. Now, how has your specific industry done in past recessions, in bad times? Step number 2, investigate the company. If the industry's okay, what about the specific firm that you're interested in? Does it have a big market share or a small one? Has it been gaining or has it been losing ground in the past few years? Is the company's management a group of experienced professionals, or are they amateurs? A group where the president gets his job from his brother-in-law and then he hires his best friend. Company strength depends. It rises or falls on management. And most important, does the company make money consistently and reliably, or do profits come and go? Step number 3, investigate the stock. Now, this is probably the most important step because this is where you really find out what you're getting for your money. Now, it is pretty tough to evaluate a stock without playing with some numbers, so I've got my trusty computer here. For those of you who aren't mathematically inclined, don't worry. The presence of a computer should not bother you. It's going to be very simple. What I want to do is find out 4 things about any stock. Number 1, I want to know its price history. Number 2, I want to know its dividend record. Number 3, I want to know the yield of my stock. And finally, I want to learn its price-earnings ratio. Now, let's take them one at a time. First, the price history. Price history is really very simple. It asks the question, how much does a stock cost now, and how has the price fluctuated over the years? A stock's price never stays the same. It goes through cycles with periodic highs, periodic lows. Frequently, these cycles establish a clear pattern. There are no rules, but if you know the price history, then you have a better chance of figuring out when the stock is a good buy. Number 2, this is the stock's dividend record, or record of dividend, which simply asks, how many years running has the stock paid a dividend? Or has the dividend been the same, or does it go up and down all the time? Does it pay good dividends during recessions? What portion of the company's profits are paid out in dividends, and what portion is plowed back into the company? Now, number 3, what is the yield of the stock? Well, this is especially important if you're buying stock primarily for the dividend. The yield compares the dividend a stock is paying to the price of the stock. Now, let's say that it's paying $1 and it costs $10 per share. The yield in this case is 1 over 10, or as our computer has just told us, 10%. If it was paying $1, but it cost $20 to buy a share of the same stock, then you get a very different yield, a poorer one. You see here, computing it out, it's 5%. All right, number 4. This is the most important. This is the price-earnings ratio, or as it's known in the biz, the PE. Stock people talk a lot about price-earnings ratios. They're a way of answering the most difficult question about a stock. Is it worth it? Is it a bargain, or is it overpriced? Now, we decided to bring in some help for this section. The computer isn't quite enough, so for a moment, forget about stock, and I want you to think chicken. Now, let's say I'm about to buy or interested in buying this chicken. It has a reputation of being a fabulous egg producer. I am told it lays 4 eggs a week, but let's take a look and see. Here's where the eggs come out. Here's the egg-producing button. 1 egg. 2 eggs. 3 eggs. 4 eggs.